Okay. Good morning, everyone. So today we commence our third session on consolidation. The previous class, I think we had seen the fair value adjustment in detail. Yes, we took the example of a non-depreciable asset, that is land. We also took the example of a depreciable asset in the form of building, and we took the example of inventory. And I had also told you that similar scenarios will apply for trade payables also. So the summary of this is what? Any fair value adjustment that needs to be done will be done in the pre-acquisition reserves. Why pre-acquisition? Because this fair valuation is done pursuant to Ind AS 103. So that is why you have to calculate the goodwill correctly, and that is why you perform a fair value adjustment. That fair value adjustment could have implications in the post-acquisition period. For example, additional depreciation or savings in depreciation, or the inventory could be sold later on, all that, or the trade payables could be paid, or the payables could be paid later on. So all the post-acquisition events, these items would be routed through the post-acquisition reserves. So that was what we had seen in the previous class. Okay, so now with that background, I had told you that we will solve one or two questions first, so that you get a hang of how the problems look like. And once that is done, we will move on to the next set of concepts. I told you to read up two or three no points also, so I hope you've gone through that. So we start with the next set of questions, that is come to question number 8. Come to, this is your test your knowledge question. Test your knowledge question. 1 second. The retained earnings. Okay. So yeah, I had asked you to try to do this, but I had also mentioned that I'll be solving it for you. So if you have tried, you can just compare your answers. Okay. Ram acquired 60% ordinary shares. Okay, of Krishan Limited of 100 each on 1st October 20x1. Okay. On March 31, 20x2, the summarized balance sheets of the two companies were as given below. Property, plant, equipment, you have land and buildings, plant and machinery, investment in Krishan Limited, inventory, and then trade receivables and cash. Equity capital you are having, reserves, retained earnings, bank overdraft, and trade payables. The retained earnings of Krishan Limited, that is my subsidiary, showed a credit balance of 60,000 on 1st April 20x1. Okay. Out of which dividend was paid on 1st November. All right. 1 second. Okay. 1 minute. There is. Okay. We'll do this in a short while. There is a small dividend adjustment. 1 second. 1 second. Blue heavens. Sorry, don't pull out that question. If you have tried it, it is fine, but I'll be picking up that question towards the later part. Okay. All right. Just a minute. Okay, what we will be doing is we will do a mix of questions 10 and 11. Let us read them together. Okay, then that should kind of keep the things in perspective. Okay, my mistake. 10 and 11 we will do together. Okay, all right. On 31st March 20x2, Blue Heavens acquired 100% ordinary shares. Okay, carrying voting rights of Orange County Limited for rupees 6,000 lakhs in cash, and it controlled Orange County Limited from that date. the acquisition date statements of financial position of Blue Heavens and Orange County, and the fair value of the assets and liabilities recognized on Orange County Limited's balance sheet were, you are having building with a carrying amount of 7,000 for Blue Heavens, for Orange County 3,000, fair value to 3,300. Investment in Orange County Limited 6,000. Inventory 700. For Orange County it is 500, fair value to 600. Trade receivables 300, 250 with a fair value 250. Cash is 1,500 and 700. Equity, you are having share capital and retained earnings and trade payables. Prepare the consolidated balance sheet as on 31st March 20x2 of the group entities of Blue Heavens and Orange County Limited. Okay, so this is the question which you are having now. We move on to question 11 because they have just made a small change. The earlier one was 100% relating to acquisition. In question number 11, the facts are the same as in question 10 above. However, Blue Heavens acquires only 75% of the ordinary shares. Blue Heavens acquires only 75% of the ordinary shares for 4,500. For 4,500. So what we do is prepare the consol balance sheet as on March 31 X2 of the entities Blue Heavens and Orange County Limited. So I will do question number 11 with the basis of question number 10. The thing is, investment here is 4,500 and therefore cash balance will go up by 1,500. Okay, so this is what is going to be the small change in the balance sheet. It's all picked up from your study module only, so this is how the question was framed. Okay, so we shall do a combo of 10 and 11. 10, the balance sheet we pick up. 11, we pick up the facts that say that 75% of the voting rights are acquired. So with that, we shall do the solutions. Okay, just a second. Question 11. Okay. All right. Everybody read the question? Yes. So now let us proceed to start solving it. Okay, so first step is, what is my first step in consolidation? Draw the balance sheet of the company, the consolidated balance sheet. You will always give the title as the company and its subsidiaries, consolidated balance sheet as at 31st March 20x2. Okay, so draw the balance sheet, keep the things ready. Then we move on to note number 1, assets and liabilities. I told you, copy all assets and liabilities as it is without any adjustment, Okay, so let us proceed to do that. You have building 7,000 and 3,000. See, I'm not giving any fair value adjustments right now. Just copy these amounts as it is, 7,000, 3,000. Inventories 700, 500. Trade receivables 300 and 250. And last one is cash 1,500 and 700 for assets. Not 1,500, sorry, 3,000. 3,000 and 700. And then we are having trade payables 300 and 150. 300 and 150. So just copy the assets and liabilities as it is. Do not make any adjustments at this stage. Okay. The next note that you will immediately draw is note number 2, equity share capital. Here it will always be that of the parent. So the parent's equity capital is worth rupees 5,000. They've not given the denomination. We can assume it to be rupees 2. So this is 5,000 lakhs. So it will be 500 lakh shares. Okay. 500 lakh equity shares of rupees 10 each. See, this is assumed. You can assume 1, 10, 100. Okay. Fully paid. So 5,000. Okay. So straight away put this in your equity capital. There was no change to that. Okay. So this is 5,000. Okay. Next. Consolidated other equity will ultimately flow in from working note 1. There is only one item, retained earnings. It will come from working note 1. Okay. Consolidated other equity, working note 1. What you will do is here you will populate standalone of the parent on the date of consolidation. So retained earnings is 10,200. Okay. All right. So what all have we covered now? Building, inventories, trade receivables, cash, share capital, retained earnings, trade payables. So we are left with only three things now. That is investment, share capital of the subsidiary, and retained earnings of the subsidiary. Acha, when did the acquisition happen? Acquisition happened on 31st March 20x2, and we are given balance sheet as on that date itself, the acquisition date statements of financial position. So these are the balance sheets as at 31/3/20x2 itself. Okay, and we are preparing the balance sheet for that date. So where will these items go? Well, investment will be eliminated through the cost of control account. Okay, so first thing what you do is go to your cost of control account, which is working note number 2, to investment in Orange County Limited. Okay, what is the value? 4,500. So with this elimination, I have eliminated this 4,500 also. So now all that I'm having is share capital and retained earnings. Okay, so let us then proceed to share capital. What is the stake acquired? 75% stake. So what is the stake of non-controlling interest? 25% stake. 25% stake. Acha. Which method shall be followed? Look at the information in the question. Are you given fair value of NCI or the equity share capital of Orange County? Nowhere is that information given. So which method will we be following? We will be following proportionate net assets method. Okay, proportionate share of net assets. Okay, always make a habit to write this. Proportionate share of net assets. Okay, write this so that you will be clear. You don't have to hunt the question again and again. Okay, so now we are done with this. Now let us start with the elimination of the equity capital. 2,000 will be divided as 75% to cost of control by equity share capital of Orange County. So that is going to be 2,000 into 75%, 1,500. 1,500. What you cannot take as a balancing figure, fair value of assets is given. Can't we take it as a balancing figure? Which one? I'm not able to understand. Just let me know, Soham. Okay. by equity share capital of Orange County 2000 into 25%. So that gives you 500. So that is done. We shall then move on to the next step. That is fair value adjustments. Okay. And analysis of retained earnings. So let us start analysis of retained earnings, because that is the only item left from the two balance sheets which we have not considered. So we take up this 2300. Okay. So coming to retained earnings, this is 2300. Balance sheet of Orange County Limited. So ideally, this should be split between pre-acquisition and post-acquisition. Post. What is the pre-acquisition period balance? This will be as on 31st of March 20x2, date of acquisition. This will be after 31st March 20x2. So this is the balance sheet as on 31st March x2. तो इसका balance तो same ही रहेगा. Balance on date of acquisition 2300. What will be the balance here? Nothing, because basically everything is being put in on the pre-acquisition date, because we are preparing the balance sheet as on the date of acquisition. Okay. Now, any fair value adjustments are there? Yes, we are having fair value adjustments. So my fair valuation is happening of building. My fair value is happening of inventories. Trade receivables, there is no change in fair value. Cash will obviously remain the same. Trade payables, there is no change in the fair value. So we shall give a fair value impact of the building as well as the inventories as on 31st March X2, that is the date of acquisition. So come to working note number 5, fair value adjustment. This will be my initial adjustment. Initial adjustment means adjustment on the date of acquisition. Adjustment on the date of acquisition. First one is building and other PP. Building and other property, plant and equipment debit. So this is going to be 3,300 minus 3,000. So that gives you 300. That gives you 300. Okay. Next one is inventories debit. This is going to be 600 minus 500. Both are upward valuations. So debit 100. Acha, what are you going to credit? Well, there are two options. First one is you can credit revaluation reserve for building and other PP. No harm in that. The only problem is you will have a separate reserve, revaluation reserve. That revaluation reserve, you will have to prepare a separate note for its analysis. And ultimately, it is on the date of acquisition. So entire value will go to pre-acquisition reserves, ultimately in the cost of control account. So that is one way of doing. The second way of doing, which I normally do and I normally teach, is put everything in your pre-acquisition retained earnings. Okay. So to pre-retained earnings. Retained earnings. We have discussed in detail why it should be pre-acquisition already. Okay, so there is no further discussions to be done on this. So where will the impact go? Building and other PPE will go as a part of note number 1, where we have copied the value of assets and liabilities as it is. Note number 1. And where will my pre-acquisition retained earnings go? Well, this will form a part of working note 4. That is my analysis of reserves. That is the analysis of reserves. Okay. So with this background, let us start giving the effects. First two effects will be given in this. So here building and other PPE, I will add 300. Inventories, I will add 100. Inventories, I will add 100. So that takes care of the first effect. The second effect, you go to working note 4 and here you will write add fair value adjustments. This is coming from working note 5. The amount of fair value adjustment is 400. So this comes to 2,700. No further adjustment, nothing to be done. So this one needs to be split between two parties. That is, one is the parent, which is Blue Heavens, and the second is NCI. In what ratio? 75%, 25%. So this comes to 675 and this comes to 2025. Where will 2025 go? Sir, this is pre-acquisition. So this goes to cost of control account. And where is that cost of control? Working note 2. Where will this 675 go? This will go to NCI account, that is working note 3. So that takes care of my fair value adjustment. Have you all understood? Yes. So I'll come to your query. Okay. I'll come to your solution. Okay. I mean your query. Okay. Is it done? Are you guys with me? Yes. Done. Are you understanding? With me is okay. Are you able to solve? I think many of you are solving physically. That is why the answers are flowing in slowly, which is good. All right. Rashmi confirmed. Kaushiki confirmed. Soham. Srishti, are you able to follow? Sumit Jain, good morning. Namaste. Are you able to follow? Aniket Jain, are you there? Shailendra, are you there? Where are the usual guys? Rashmi, Shailendra. Okay. Nidhi Deshpande, are you there? Okay. All right. Fine. So now just post the effects by pre-acquisition retained earnings. Retained earnings. This is from working note 4. Working note 4. Pre-acquisition retained earnings was worth 2025. 2025. Good morning. Good morning. Okay. And then write in the wrong accounts. ये NCI है, so this will be 675. COC में I will write by pre-acquisition retained earnings. Working note 4. 2025. 2025. That's it. No other adjustment left. So balance your NCI. Balance your NCI. 1,175 is the total. I am not given fair value of NCI. So straight away I will be having to balance carried down 1,175. 1,175. Okay. No further adjustments. Then you move to cost of control account. Debit side is higher, so it will result in a goodwill. So balance this 4,500. 4,500. So 4,500 minus 1,500 gives you 3,000 minus 2,025 gives you 975. This is nothing but your goodwill. This is nothing but your goodwill. Okay. Acha. Any post acquisition reserves you are having? Answer is no, you won't. So add post acquisition reserves from Orange County Limited. Nothing is there because this is the balance sheet on the date of acquisition. So 10,200. 10,200. Okay. So here retained earnings will obviously be 10,200. Okay. And now all impacts are given, all totals are balanced, no working notes left out. So add up your assets and liabilities. 7 plus 3, 10 plus 300, 10,300. Inventories 1,100. This is 550, 3,700 and 450. 450. Start posting the respective items in the balance sheet and your balance sheet should tally. Okay. So property, plant and equipment stands at 10,300. Goodwill is 975 from working note 2. From working note 2. Non-controlling interest is from working note 3 and that is 1,175. Okay. Rest all do the postings 1,300, 1,000 inventory. What is wrong today? Simple mistakes. Yes, 1,300. Okay. Financial assets, trade receivables, 550. Cash and cash equivalents was at 3,700. Trade payables you are having at 450. 450. So retained earnings, other equity, 10,200. So property, plant, equipments come from note number 1, inventories note number 1, trade receivables, cash and cash equivalents note number 1. Other equity is from note number 3, trade payables is from note number 1. So now just total up the balance sheet and I think it tallies at 16,825 on the asset side. 16,825 on the equity and liability side as well. Okay. Have you understood? Have you guys understood? Yes. Done? Please confirm. Okay, so हम confirmed. Others, Kaushiki, Rashmi, Srishti, Sumit, Shailendra, Aniket. Done. Okay, Rashmi also confirmed. Yes, what about the others? Srishti, are you there? Kaushiki also confirmed. Others? Another 2-3 confirmations. Okay, all right, fine. So that takes care of this question. Now, it's better if you take, but again, the choice is yours. Okay. See, I had drawn this format so that I save time. See, the first time I took consolidation, we were allotted quite a sizable chunk of classes. Okay. But the issue was that we started eating into other faculty sessions. Okay. So other faculties had shortage of time because FR went way ahead of its budgeted hours. So what it was thought is we reduced the number of hours. So since the number of hours reduced, what I did was I started drawing up these formats. Okay. So it quickens our job. You take the printout, your job will be faster. Okay. Take the printout, your job will be faster. Okay. Srishti, why the cash is 3000? Okay. Why the cash is 3000? Okay. All right. See, I told you, read question number 10. Question number 10 says 100% ordinary shares. But read question 11. It is saying same as in question 10, but Blue Heavens acquires only 75% for 4,500 lakhs. That means instead of 6,000, I took it as 4.5. So 1,500 it has paid less, no? So that amount goes in cash. Okay, so that is why 1,500 became 3,000. Okay, I didn't do 10 by itself because usme non-controlling interest would not have come since it is 100% acquired. So that is why I said we will do 10 read with 11. Okay, so in 11 NCI is there. That's it. Okay, so that is why you acquired for 4,500, balance 3,000 means that results in cash increase of 1,500. Okay, so that is done. 400 was fair value adjustment pre-acquisition. Yes, fair value adjustment pre-acquisition, definitely. Because it is on the date of acquisition. Okay. This is a case where you are preparing the balance sheet as on the date of acquisition. So could you follow the 6-step approach? It's not clear. Okay. All right. Simple to hai. It's a bit confusing, but it's quite simple. See, question number 10 tells you 100% ordinary shares are acquired for 6,000 lakhs in cash. Okay. So, question 10, 100% acquired 6,000 lakhs in cash. Question 11 adds that facts are same as in question 10 above, but Blue Limited acquires only 75% for rupees 4,500 lakhs. 4,500 lakhs in cash. तो फर्स्ट केस में what is the payment which is being done? 6,000 lakhs. Second case में what is the payment being done? 4,500. They are two different cases. First case is different, second case is different. Don't mix both of them and say that question 11 is in addition to question 10. Question 11 is substituting this information. It is substituting this information, and because it is substituting this information, what will be the effect? The effect will be, in question 10, you would have passed the entry investment in Orange County debit 6,000 to bank 6,000. What question 11 is telling? It is not 6,000. It has acquired it for 4,500. That is why the cash balance for the purposes of question 11 increases by 1,500, which is the impact we had given here. This is 3,000 and this is 4,500. I hope that it is clear, Srishti. Okay. All right. Next one, Kaushik. Key working note 1. Okay, so 400 was fair value adjustment pre. So post acquisition, we don't have anything, right? So nothing will come here. In the consolidated equity of the parent, you can only add post acquisition because those are the profits which you have earned. So here no additions will come. That is why it won't be a part of post acquisition reserves. Okay, so that takes care of this question. Everybody is clear with this question? Yes. Okay, since this is a consolidation that is happening on the date of acquisition itself, okay, I'll just rub this part. It's anyways clear. Okay, we could also follow the 6-step approach. The 6-step approach of business combination. So first step, identify the acquirer. Acquirer is the Blue Heavens company. Okay, date of acquisition 31st March X2. Third step is PC. So step number 1, acquirer is Blue Heavens. Step number 2, date of acquisition 31st March X2. Step number 3, purchase consideration is 4,500. Step number 4 is net assets acquired. Now the net assets acquired is how much? What are we going to take? The net assets acquired will be fair value 3,300, 600, 250, 700 and 150. Okay, so this is going to be 3,300 plus 600 plus 250 plus 700 minus 150. So that gives us how much? That gives us 3,300, 3,900, 4,000, 4,700. Net assets acquired is always at fair value. Remember Ind AS 103, this will always be at fair value. So 4,700. Am I right? Somebody please confirm 3,900 plus. Yes, I'm right for a change. Okay, at fair value. Step number 5, NCI. This is going to be proportionate share of net assets. So 4,700 into 0.25, that gives you 1,175. Step number 6, goodwill is equal to PC plus PC 4,500 plus NCI 1,175. That gives you how much? 5,675 minus net assets. Net assets acquired is 4,700. So minus 4,700, you are left with goodwill of 975, which is exactly the same goodwill that we have recorded, in our consolidated balance sheet. So to put Soham's thing in perspective, Soham has asked, could we do an alternative saying that can we not take the net worth as the balancing figure? Yes, that's exactly what you can do. But the problem by taking net worth as a balancing figure is that you will end up thinking a lot. Okay. You may end up thinking a lot about it. So this approach works best with me because what I come to know is whether I have taken all the items in the adjustments or not. That is why I take share capital separately. We take retained earnings separately and do the adjustment in the retained earnings. It may be possible that for one of the cases, nothing is mentioned. Like cash. Cash will typically not have a fair value. So they keep it as 0. So in that case, if you are in an exam scenario, you are in a hurry to complete, you could probably rush through the whole thing and then you will avoid this cash because uska fair value diya hi nahi hai. So that time your balance sheet will not end up tallying. So you may end up with spending say 5 minutes extra in searching where the difference is. So that is precious for us. So that is why we take a slightly long route to include each and every line item of the parent as well as the subsidiary. That is why we prefer that. But you can take the net worth and do it, which is exactly what we did in the 6-step method. Okay, so that is how you will be. So that takes care of question number 10, 11. Okay, so question number 10 you can do. It's just that NCI will not be there. Remaining everything is the same. Okay, this will be 6,000. This will be 1,500. That will be taking care of it. Okay, so we move on to the next question. That is question number 12. Which is an extension of 10 and 11. Okay, it's a good thing. So step by step, you can see how the impacts are getting adjusted. Okay, so facts are same as in questions 10 and 11. Blue Heavens acquires 75% of Orange County Limited by paying 4,500 lakhs for the shares. At 31st March 20x3, now this is after the date of acquisition. That is 1 year after Blue Heavens acquired Orange County. The individual statements of financial position and statements of comprehensive income of Blue Heavens and County Limited are as under. Okay, so you are having property, plant, equipment, investment in Orange County Limited, trade receivables are there, inventories are there, cash is there, share capital, retained earnings, and trade payables. Statement of profit and loss for the year ended 31st March 20x3. You are having revenue, cost of sales, gross profit, administrative expenses, profit for the year. Blue Heavens estimates that goodwill is impaired by 98. The fair value adjustment to buildings and other PP is in respect of a building. All buildings have an estimated remaining useful life of 20 years from 31st March X2 and estimated residual values of 0. So no residual value. Blue Heavens uses the straight line method for depreciating the property, plant and equipment. All the inventory held by Orange County at 31st March X2 was sold during X3. Prepare the consolidated balance sheet as on 31st March X3 of the group of entities Blue Heavens and Orange County Limited. Okay, so this is your question number 12. Same facts as 10 and 11 as far as acquisition is concerned. Later on, 1 year of operations are carried out and those are the balances which you are able to see in the question. Okay, so now with this background, let us proceed to solve question number 12. Okay, let us move to solve question number 12. Okay, See, as of now, for the purposes of the class, it's okay if you don't draw these formats. Okay, this format, you can always do it up at your later on after the class, because all the balance sheet totals are given in this note, assets and liabilities. And goodwill is going to come from working note 2, which is there, and NCI is going to come from working note 3, which is there. Equity capital is of the parent always. Consolidated. So all the details are there here. It's just a matter of posting in the balance sheet. If you don't have the printouts, don't worry. You need not spend time to draw this and lag behind in terms of understanding. Drawing, you can postpone it after the class. Okay. What is important now is us understanding how consolidation flows. Okay. How consolidation. Balance sheet will always tally. Okay. At this stage in CA final, I don't think tallying the balance sheet should be a task requiring lot of effort for you guys. Okay. So now coming to the question. First step, draw the format. It's drawn already. We move on to the next step. The next step is recording all assets and liabilities except 3 items: investment in the subsidiary, equity share capital, and reserves. These 3 will not be recorded. Remaining all you record with adjustment or without adjustment. Answer is without adjustment. दिमाग लगाने का ही नहीं, जो दिया है लिख के खत्म कर दो. Okay, so let us start. Building and other PPE appears at 6,500. This is at 2,750. Okay, next one is, so we have considered this, Now inventories 800 and 550. 800, 550. Trade receivables 380 and 300. Cash 4170, 1420. Trade payables 350 and 170. Okay, so that takes care of which all items? Inventories, trade receivables, cash, trade payables. Okay, so we are done with all these items. So now what is left with is share capital, investment, and retained earnings. So now let us proceed to first record the share capital of the parent. Equity share capital 500 lakh equity shares of rupees 10 each assumed. It's not given. Fully paid. 5,000. 5,000. So that is done. So now post it also immediately. If you have the balance sheet ready, post it. Equity share capital 5,000. Okay. All right. Consolidated other equity. What are you having is consolidated retained earnings. This is going to come from working note 1. So once working note 1 is complete, we will record it. So working note 1, consolidated other equity. You can write here standalone. This is of the parent. To this you will be adding the post-acquisition profits. Blue Heavens Limited as on 31st March 20x3, which is your date of consolidation. What is the balance in that retained earnings? 11,000. Like this, you should be having it for all the items of reserves, okay, or other equity. So that takes care of 5,000. That takes care of retained earnings. So now we are left with only two items. One is investment and the other is the share capital and retained earnings of Orange County, which we are now going to give effect to. So first thing is eliminate the investment in the cost of control account. So that is done. Then all the items in blue heavens are taken care of. So to investment in Orange County Limited, 4,500. So with that, all my items of the parent are considered. Now we move on to the subsidiary. The first step is elimination of subsidiaries equity. So by equity share capital of Orange County Limited. By equity share capital of Orange County Limited, this will be 2,000 into 75%. Write the stake, 75% stake. So this is 1,500. This is 1,500. Here also you can write down 25% stake. Which method are we following? Proportionate share of net assets. Proportionate share of net assets. Equity share of Orange County will be of date of acquisition and not of date of consolidation. In this case, it's the date of consolidation only, no? It's the date of consolidation. See, I'm ultimately eliminating the equity capital on the date of consolidation, which is the date of acquisition, So typically, I mean, if you look at the principles, it has to be the date of acquisition, because the net assets on the date of acquisitions, you will have to eliminate with the investment. So it will be the date of acquisition. And generally, it will be the same. The question arises, what if my equity capital were to change? Matlab, date of acquisition, you have a particular equity capital. Date of consolidation, you have another figure of equity share capital. What are you going to do in that case? See, changes in equity capital can happen on account of two things. First one is bonus issue. If there is a bonus issue, my percentage stake is not going to change, but there are some consolidation adjustment, which is a separate topic for discussion. So along with dividend discussion, we will be covering bonus as well. So that is separate. So your equity capital can change on account of bonus. Your equity capital can also change on account of a further issue. So if it is a further issue, the question arises, are you acquiring in proportion to your share, or are you not going for the acquisition, or are you acquiring more than your share? So that will amount to change in the percentage of holding when you are not acquiring additional shares or acquiring more than what you are going to get. So when that is the case, it will amount to two things. One is purchase or stake addition when control already exists. Second one is a stake reduction, which gives rise to again two options. First one is stake reduction with control that is being retained. The second one is stake reduction with loss of control. In all the three cases, we have separate adjustments for which we have to discuss that separately. Okay, so to put your question in perspective, what will be the equity capital? For now, just understand that it is the capital as on the date of acquisition. So it was 2,000 earlier also. Yes, you can see this capital in the earlier question was 2000. Same question is brought forward. Okay, so 10, 11, 12 are all same questions. Okay, so 2000 is the balance sheet on the date of acquisition. Okay, the equity capital on the date of acquisition. Okay, so that is done. So by equity share capital of Orange County Limited, 2000 into 25%, 500. 2000 into 25%, that is 500. Okay, so that takes care of equity capital. We now move on to retained earnings. 2850. Balance sheet of Orange County on date of consolidation. So this we will have to split between pre and post. Pre and post. So now pre means balance on 31st March 20x2. They have not given separately in this, but since it is an extension, we can easily pull it out from here. 2300. 2300. And then profit for 20x2 x3. 2850 minus 2300, 550. 2300, 550. Alternatively, you could also take 550 from here. That is why these profits are given to you. Alternatively, you could see that Orange County's profits are 550. So you have taken this 550. So whatever you want, however you want to interpret, you can interpret. You can say either of the figures are balancing figures, or you can say that 2300 pre is given, 550 post is given. So therefore, that is how the question is. Okay, so you can take either of the ways. Choice is yours. Okay. All right. So as of now, this is the case. And then we move on to fair value adjustments. Okay. Blue Heavens estimates a goodwill impairment we'll see later. The fair value adjustment is in respect of building. All buildings have an estimated remaining useful life of 20 years from March X2 and estimated residual values of 0. Blue Heavens uses the straight line method for depreciation. All inventory was sold as on during the year 20x3. Okay. So now coming to our fair value adjustments. Here I will be having first thing, initial adjustments. It is the same what we did in the last problem. Building and other PPE debit, inventory debit to pre-retained earnings. $300, 100, 400. So that is the same what we had done in the earlier one. Okay, so where are you going to give the effect of this? Note 1, and this will be working note 4. This will be working note 4. So go to note number 1. Building and other PPE, add 300. Inventory, add 100. Inventory के case में you can add 100. Okay. So that is done. Let us move on to the next this thing. Let us move on to the next. Do I have any subsequent impact? Yes. Additional depreciation 1. Second is sale of inventory. So we will have to consider those 2 items. Okay. So subsequent adjustments. Okay. See, building's value is increasing from 3000 to 3300. So that gives me a upward valuation. Because of upward valuation, depreciation also should increase. So what I want you to tell me is, can somebody tell me what will be the additional depreciation that needs to be recorded? What is the additional depreciation that needs to be recorded on account of fair valuation of building? Okay, give your answers. All the data is there. Give your answers. Retained earnings may later. Add this. You give the answers. What will be the additional depreciation? Yes. Depreciation of 15. Depreciation of 15. Absolutely right. See, look at the problem. All buildings have an estimated useful life, remaining useful life of 20 years from the date of acquisition. Okay, with a useful life of, with a remaining value of 0, that is the scrap value. So therefore, you have increased the value by 300. Remaining life is 20. So therefore, your depreciation is 15. Your depreciation is 15. Okay. Suppose you were doing the consolidation. Suppose you were doing the consolidation after 5 years from the date of acquisition. In that case, you would multiply 15 with 5, 75, and take 5 in your retained earnings, because you are computing the retained earnings post acquisition for the period from date of acquisition till date of consolidation. It is not necessary that that period should be 1 year only. The question can tell, prepare the balance sheet as on this date, and acquisition happened 5 years ago. So will you again take 15 only for 1 year? Answer is no. You have passed a period of 5 years after the date of acquisition, and therefore in such cases you will take 5 years. So since this problem only 1 year has passed, we are taking 15 lakhs. Okay. So that is the additional depreciation adjustment that you need to do. So you can write down. It is increase in depreciation, so it will be debited. It is happening after date of acquisition, so it is post retained earnings. Post retained earnings debit 15. This is nothing but additional depreciation for X2, X3, for 20X2, 20X3 to building and other PP 15. How are you calculating it? 300 divided by 20 years. So this is nothing but fair value adjustment on building. In this case, it is an increase. That is why it is positive. If it is a decrease, you will write as negative. It will give rise to savings in depreciation divided by useful life of building. Useful life of building. Okay. Since only 1 year has passed, we have taken it as 15. If 2, 3 multiple years have passed, you will multiply that with the depreciation. Okay. We can just write that down. 1 year passed since acquisition, comma, computed. Additional depreciation is computed for only 1 year. If more than 1 year had passed, comma, consider such number of years. In post depreciation calculation. Okay. Is everyone clear with depreciation? Yes. Yes. All right. Now see, we could have some of you who will look at 3,000, fine, 2,750, and they will say, sir, depreciation is 250. Depreciation is 250. In 1 year, depreciation is 250. This is in respect of all items of buildings, property, plant, equipment, all of them put together. It's for all of them put together. Don't compare this 250 with that 15 and say this is quite high. Okay. Anything could happen in this. Okay. So 3,000 to 2,750 includes all other property, plant, and equipment also. But the fair value adjustment is only in respect of building, and that building's remaining useful life is also given. So therefore only 15 is pertaining to the revaluation. Only 15 is pertaining to the revaluation increase. Okay, so that is done. Now let us move on to the next one. We had an upward valuation of inventory from 500, it became 600. Okay, before that, let us give effect to this. Post retained earnings goes where? Sir, this goes in working note 4. This goes in note 1. This goes in note 1. Okay. That's right. That is for the original block. Okay. So working note 4 and note 1. So now let us give the effects. Working note 4. Working note 4 is other reserves. So here you will be writing less additional depreciation. Working note 5. Additional depreciation is worth 15. Additional depreciation is worth 15. And give this effect in note number 1 also, the second effect, plus 300 minus 15. Plus 300 minus 15. All done? Given the effects, record, give the effect, record and give the effect. Okay. Record and give the effect. All effects given. Creating some space. Okay. All right. Now we move on to the next part, inventory. Inventory, is it sold? They have written all the inventory held by Orange County as at 31st March X2 was sold during X3. All the inventory held by Orange County at 31st March X2 was sold during X3. So some intelligent student will look at the balance sheet and then he will say, but sir, inventory is 550. Inventory is 550 and here it is 500. तो कहाँ sell हुआ है? उल्टा inventory बढ़ गया है ना? That is what you will have some students thinking. अरे, what would have happened is this 500 is sold and it is inventory. It is a moving item. So you would have purchased some more, and from the current year's purchases, this would be what is there in the balance. So don't get confused saying that question is incorrect. Question is not incorrect. You have to think that if they've told that wo inventory big gaya, it is fine. It's normal. You're able to sell your inventory. So that is a good thing. All right. So you sold that inventory, but these are inventories. You have to buy and keep them, sell them or use them for production, whatever it is. But it requires a turnover. So this 550 represents the inventory which is going to be from the current period's purchases. It has nothing to do with the opening balance of inventory. So don't get confused with that. Okay. Don't get confused with that. Okay. So inventory is sold. So you had increased the value from 500 to 600. That inventory is sold. So you will have to remove that now. So the adjusting amount will be 100. The adjusting entry will be post acquisition retained earnings account debit to inventory. Post retained earnings account debit to inventory. Okay. So you can write here. 1 second. This is building and other PP. Okay. And this adjustment now is for inventory. Entry will be post retained earnings debit to inventory 100. Post retained earnings effect goes in working note 4. Inventory goes to note 1. At every point when you start giving double effects, your chances of going wrong is very, very less. Okay. So give the effects minus 100 and then go to retained earnings, and वहां पे लिखो less change in opening stock. That is nothing but cost of goods sold. 100. Okay. So that takes care of that. All right. You guys need a detailed note on this, or आपको याद रहेगा what did we do exactly? What do you think? Do you guys need a note for inventory, or if you need a note, we can write it down. Otherwise, this is the effect which is given. So from the exam perspective, clarity perspective, it's done. But if we have to have a note, okay, we'll have a note. All right, we'll first finish the problem. And then we'll write the note on inventory. Okay, we'll write the note on inventory later on. I'll give it to you. Okay, so that is done. Impacts are given. Now we move on to impairment of goodwill. Okay, impairment of goodwill. Okay. We'll come to that later because it will not affect any other working note as of now. Okay, so this is 2,700 and this is 435. So split this up. Blue Heavens, NCI. What is the rate? 75, 25, 75, 25. 2025, 675. You take the decimals because all these figures are rupees in lakhs. So 326.25, 108.75. And where these items will go, this goes in working note 2. This goes in working note 3. This goes in working note 1. And this goes in working note 3. Always give the reference to the working notes. Okay. Since for most of the problems, the formats are standard, you will have the same working notes which will continue. Okay. All right. Now give the effects by pre-retained earnings. Kitna hai for NCI? Well, for NCI, this is 675. For the parent in the COC account, by pre-retained earnings, this is 2025. Okay. And then post retained earnings, 108.75 will go to NCI. Post retained earnings. Working note 4. So this is 108.75. Post retained earnings will not be a part of cost of control. It will be a part of consolidated other equity because these were earned when the parent had control over the subsidiary. Okay, so add share in PAP, post acquisition profits of Orange County Limited. Working note 4. So that is 326.25. Okay, so I have given effect to all this as well as the revaluations. So all this is done. Only one item is left. That is impairment of goodwill. That is impairment of goodwill. Okay, so impairment of goodwill is 98. Impairment of goodwill is 98. Okay. Acha, this is a management estimate of the goodwill that is impaired. This is a management estimate of the goodwill that is impaired, and therefore we will have to uh, give effect to the impairment. You tell me one thing. Where is this goodwill appearing? I'll give you three options. First option, it's appearing in the standalone books of the parent. Second option, it's appearing in the standalone books of the subsidiary. Third option, goodwill is appearing in the consolidated financial statements. Fourth option, none of the above. Okay, so out of these four options, where is the goodwill appearing? Where is the goodwill normally appearing? Standalone parent, standalone subsidiary, consolidated. So somebody is saying COC account, which is correct. COC account is prepared in the consolidated financial statements only. So that means this goodwill is coming in the consolidated financial statements. Okay. So since this goodwill is coming in the consolidated financial statements, where are you going to give effect? Can you give effect in standalone? Arey, goodwill hai nahi wahan pe. So therefore, this will surely not be an adjustment of the subsidiary standalone. No, because subsidiary standalone will not have this goodwill. Acha, to parent ka hoga? No, it won't be the parent also, because parent standalone records investment in subsidiary. Okay, it does not give effect to all assets, liabilities, etc. So वहां पे भी आपके पास goodwill नहीं होगा. The goodwill will be a consolidation adjustment. The goodwill will be a consolidation adjustment. Okay. Now the question is, this is a loss of 98. This is a loss of 98. Goodwill is impaired by 98, means it is reduced by 98 rupees. The question that arises is, who should bear this loss of 98? देखो, consolidated financial statements में I am having goodwill. Now, since this goodwill pertains to the subsidiary, there are two parties interested in that. One is the parent, the other is the NCI. Both have invested in the subsidiary, and goodwill is arising on account of acquisition of the subsidiary. So now my question to you is, look at the question, see your answer, and tell me which entity will bear the loss of this 98 rupees. Will it be borne by the parent only? Will it be borne only by the NCI? Will it be borne by parent as well as NCI in this case? And what is the reason for your answer? Okay, so just understood the question. 98 is a loss, so goodwill has to go down. That means goodwill will be credited. So debit में हमें loss book होगा. My question is, who will bear that loss? Will it be borne only by the parent? Will it be borne by the subsidiary, by the NCI? Or will it be borne like all incomes, expense, reserves, etc.? Will it be borne by parent and NCI proportionately? And your reasoning why? Okay. You should tell me the reason why you chose that answer. Okay. Why it has to be both? Why it has to be either of the two? Give me reasons. Okay. Give me the reasons. Okay. Two people gave answer. One is telling it should be shared by both parent as well as NCI since it is on account of consolidation. One answer is saying it should be borne only by the parent. Okay. Another is saying only by the parent because parent estimates the impairment. Okay. All right. Any other reasonings? Any other reasonings? Boys, Sumit Jain, are you there? Shailendra, are you there? Kaushiki, are you there? Are you there? Okay, fine. Goodwill is in the consolidated books because it cannot come in standalone. It's coming in consolidation first. Second, the parent estimates the impairment to be 98. It will always be the parent who estimates. Okay. Regardless of who shares it, it is always the parent who estimates impairment of goodwill because it is the parent which prepares the consolidated financial statements, because it is the parent who prepares the consolidated financial statements. वो NCI बैठा उसको क्या पता चलेगा? He does not have the control also. He does not control any activity. So there won't be goodwill as far as the NCI is concerned. For the NCI, it is just investment in investment in Orange County Limited. That's it. He's not controlling any activity, directing any relevant activity, etc., etc. Okay. So that is the first answer. Means I negate that reasoning which says that because parent has estimated, parent he estimate karega hamesha. So that is not a reason. That is not a reason. Okay. Now the next thing is, to answer this question, you will have to look at which method of NCI you are following. Which method of NCI you are following? Sir, we are following proportionate share of net assets. In proportionate share of net assets, you only tell me, will NCI have a share in the goodwill? You only tell me, will NCI have a share in the goodwill in proportionate share of net assets or no share? No share. Because NCI will get a share only if NCI is at fair value. हमने detail में देखा था. In this case, it is proportionate share of net assets. So NCI has no share in the goodwill. And because NCI has no share in the goodwill, now you tell me, who will bear the loss of this goodwill? यार जिसके पास asset है, the asset is attributable to the parent or to the NCI or to both. Asset is attributable to the parent only. This is the goodwill. Since goodwill is attributable to the parent alone, the impairment loss also will be attributable only to the parent. The impairment loss will be borne only by the parent. NCI has no share in this goodwill, so NCI will not share the impairment loss. NCI वाला कल balance sheet उठा करके देखेगा, consolidated balance sheet, he will see goodwill is debited to my claims. NCI will say, how are you debiting goodwill to my claims when I don't have a share in your goodwill? जब मेरे पास asset ही नहीं है, उसका impairment मैं क्यों bear करूं? That is what NCI will put the argument. So parent has recorded goodwill attributable to itself, and that is why it will be recorded. The question that next arises is, sir, what if NCI is at fair value? What if NCI is at fair value? So quickly, we shall look at the next note. That is, we completed one concept, that is fair value adjustment. We now come to the next concept, impairment of goodwill. So Ind AS 36 requires goodwill to be tested for impairment. In case goodwill is impaired, the impairment loss needs to be adjusted as under. Impairment of goodwill, you have partial goodwill, which is what we are doing right now. I have given you note reference also. Refer question 12, working note 6, which we are going to do right now. It belongs only to the parent. and hence entire impairment loss be written off to the consolidated P&L, and no part of this loss will be borne by the non-controlling interest. उसका कोई share नहीं है. Entire loss will be borne by the parent in the consolidated profit and loss account. The entry being consolidated P&L account debit to goodwill. Alternatively to COC account. Why COC? I will explain to you in a short while. Okay. But this is the entry which will be passed. Okay. Now suppose it is full goodwill. Suppose it is full goodwill. Then goodwill is attributable to parent also. Goodwill is attributable to NCI also. And hence impairment loss should be shared between the parent in the consolidated P&L as well as the NCI. The question is, sir, किस ratio में जाएगा? The question is which ratio it will go to. I'll just write here. We will be discussing it. I'll give the solution in a while. Sir, what do you mean by किस ratio में जाएगा? See, I am having parent, I am having NCI. ये दोनों के केस में I am having one ratio which is stake. In this case, 75%, 25%. I am having another data that would be goodwill before impairment. That is attributable to the parent. Goodwill before impairment, that is attributable to the NCI. Goodwill before impairment, that is attributable to the NCI. And now the question is, in which ratio are you going to impair the goodwill? Will you impair it in the ratio of stakeholding, or will you impair it and transfer the losses to the parent as well as NCI in the ratio of goodwill attributable to parent and attributable to NCI, in that ratio prior to impairment? किस ratio में आप divide करोगे? Did you understand? Yes. Did you understand? किस रेशियो में डिवाइड करोगे? Will you attribute goodwill impairment to the parent and NCI in the ratio of the stake, or will you attribute it in the ratio of goodwill allocable to the parent and NCI before impairment? कौन से रेशियो में आप उसको allocate करोगे? Some people are saying stake, some people are saying in the ratio of the goodwill as is attributable to the parent and NCI prior to impairment. The standard is not clear on this. Okay, the standard has not given a clear-cut guidance on this. The standard tells you have to distribute it, share it between the parent as well as the NCI. So when that is the case, कौन सा method follow करना है? Choice is yours. Choice is yours. Okay. So this is what happens. Apportionment of allocation loss of impairment loss. Option 1, allocate in the ratio of shareholding of parent and NCI. This is an option available to you. Or the second option is allocate in the ratio of goodwill attributable to parent and NCI prior to impairment. Option 2. The question is, कौन सा follow करे? In exam, कौन सा follow करे? Typically, you can go with option 1. भाई stakeholding है, stakeholding में divide कर दो, बात खत्म. You don't have to break your heads. But if you were to ask my personal opinion, I would stick with option 2. I'll give you the reasoning for that. I'll stick with option 2 because suppose the stake is 75-25. My goodwill apportionment will not be in the ratio of 75-25. नहीं होगा ये. My goodwill that is attributable to the parent and goodwill attributable to NCI will never be in the ratio of 75-25. Why is that going to be the case? Because in the case of the parent will pay a far higher amount for acquiring a controlling stake because of the concept of control premium. याद रखो, याद करो, when we had studied NCI, I had told you that NCI will pay a higher amount compared to what is the market price. Sorry, the parent will pay a higher amount compared to what is the market price because it is acquiring a control. So therefore, since its investment is higher in proportion to its stake, the payment amount is higher in proportion to its stake, the goodwill will be attributable a higher amount to the parent as compared to that of the NCI. So typically it could be like 85 and 15, for example. So I would personally go in for option 2 because option 2 seems more logical. There could also be a hypothetical scenario academically that when you allocate the impairment loss to goodwill in the ratio of the stake, then it could so happen that impairment loss attributable to NCI would be higher than the goodwill itself. ऐसा हो सकता है because दोनों का ratios अलग-अलग है. Both ratios could be different. At that time, we may end up in a confusion. So that is why the safest method is second option, that is allocate it in the ratio of goodwill prior to impairment. उसमें आपका कभी भी you will not get an illogical answer. You will get a logical answer because जितना goodwill है उतना ही loss हम bear करेंगे. That is the argument for the second one. Okay, so personally I would go with option 2, but academically please stick to option 1. And option 1, I'm not saying it's completely wrong. Okay, option 1 bhi sahi hai, but for me I would always follow option 2. It makes more sense to me. Standard क्या बोलता है? Standard कुछ भी नहीं बोलता है. The standard only tells if it is full goodwill, allocate the impairment loss to the parent as well as the NCI. That's it. कौन से ratio में, that is all a matter of principle which you will have to follow. Okay, so that takes care of impairment of goodwill also. So now coming to this question at hand, where do I record the impairment loss? It is a case of partial goodwill, and since it is a case of partial goodwill, it will be allocated only to the parent. Parent means what? Where it will go? Will it go in standalone? नहीं, standalone में goodwill है ही नहीं. Standalone we are not talking, we are in consolidated books. So in consolidated books, if we have to tell that goodwill is transferred only to the parent, so where it will go? The debit impact, that is the loss impact, will be borne in the consolidated profit and loss because consolidated P&L is that of the parent. तो वो खर्चा वहीं पर जाएगा. The loss will be booked in the consolidated P&L. Okay, so now you can just note this down. In this case, comma, goodwill is calculated using the partial goodwill method, and hence the loss on impairment of goodwill will be borne entirely by the parent, since NCI has no share in the partial goodwill. You should get marks if you choose option 2. I don't deny that. Okay, I don't deny that. But yes, I have seen only the 7 means the allocation of impairment loss in the ratio of the stake. So I would stick to that. Okay, honestly, I don't want us to experiment in the exam. Okay, I would stick to the answer, stick to the method followed. It's not wrong. I repeat again, what is shown to you in your study module and all is not at all wrong. It's one of the two options. Okay, so you can follow that. So entry will be consolidated P&L debit to goodwill. 98, 98. Working note 1, this will go, and this will, I'll tell where this will go. Okay. Acha. Done. Written this down. Okay. See, Kaushik option 1 will be based on the assumption, option 1 will be based on the assumption that impairment is for full goodwill, even if earlier we have used partial goodwill. See, goodwill, see, don't think that partial goodwill ek bar ho sakta hai. Next time it will be full goodwill. Then I'll do partial goodwill. Nahi, goodwill arises only once in your lifetime, and that is on acquisition. On the date of acquisition. वो goodwill का वही मकसद है. It is arriving, taking birth only on the date of acquisition. So on the date of acquisition, what is the accounting choice that you make will stay with you for a lifetime. The accounting choice that you make in respect of goodwill is going to stay with you for a lifetime. You cannot say on the first date of consolidation, I will follow partial goodwill. Second year of consolidation, I will do full goodwill method. Third year, I'll do full. Fourth year, I'll do partial. वो आप नहीं कर सकते. You cannot do that. Once you choose what method to follow on the date of acquisition, that goodwill, wo chahe partial ho ya full goodwill ho, that is going to remain with you for the lifetime as long as you maintain control in that subsidiary. So therefore, the allocation options are not based on the assumptions that if this was partial, ye hoga, if this was, no, it's based on a very sound principle that I can allocate the loss in the ratio of the stake because all the incomes and expenses of the subsidiary are getting allocated in the form of net profit, ultimately in the ratio of stakeholding, ultimately in the case of stakeholding. Okay, so that is how you will do the allocation. Okay. What will be the reasoning for option 1 in case of partial goodwill? What is option 1? Okay. Allocate in the ratio of shareholding of parent. See, partial goodwill में तो ये आएगा ही नहीं ना. In the case of partial goodwill, this whole thing allocation is only for full goodwill. Partial goodwill में entire thing is borne with the parent only. So therefore, there won't be a case of allocation in partial goodwill. Allocation will always be for full goodwill only. Option is whether to go in the ratio of shareholding or whether to go in the ratio of goodwill prior to impairment. Okay. So partial goodwill, there won't be any allocation, which is what we are discussing now in this question. Consolidated P&L debit to goodwill. Okay. Therefore, goodwill after impairment will look something like this. As on date of acquisition. Kitna tha? If you remember, it was 975. less impairment, 98. So this leaves you with 877. Goodwill after impairment. So this is how the effect will be given. Now see, you are in exam stress. Okay, just imagine you are in exam stress. You have done everything fine, but end moment mein you had to give impairment of goodwill. You gave the debit impact in the consolidated P&L. Let us give the debit impact. Okay, let us give the debit impact less impairment of goodwill, 98. 98. Okay, so you have given the debit impact and you balanced your NCI, you totaled up everything, you balanced your cost of control, but in the end you forgot this step. In the end you forgot this step, and what you will do is you will go on breaking your head, where is this 98, where is this 98, and within 2 to 3 minutes you will end up finding also where this 98 has gone. But फिर वो काटना पड़ेगा. Goodwill appears on the face of the balance sheet, तो balance sheet के face पे you will end up making scratch marks. To avoid all that, what you can do is, instead of crediting goodwill, you directly credit cost of control account in working note 2. Directly credit cost of control. तो जो goodwill आएगा, it will be net of the impairment. जो goodwill आएगा, it is going to be net of impairment. Okay, so credit cost of control. So go to working note 2. Okay, go to working note 2 and यहाँ पे by consolidated P&L, working note 6, goodwill impairment. And here give an effect of 98. So the balancing figure, which is the goodwill, that will be after impairment. You don't have to do any further adjustment. But jo karna hai, choice is yours. Okay. This makes your job a little simpler than it actually is. Okay. So 877. Now don't further impair this. Okay. By goodwill. This is the goodwill after impairment. Post impairment goodwill 877. Total up your NCI. Total up your NCI. 1283.75. $1283.75. 4,500 investment is eliminated, no, already. So I don't know what else is there. Okay. All right. So record this goodwill already here. Working note 3, 877. 877. Okay. All right. Fine. Goodwill हो गया, NCI हो गया. All this is done. So total this up. 11,000. to 28.25. 0.25. Okay, that's it. Then just give the effects. This is 680. Total up these items. 6,500. 9,535. 1,350. 5,590. 520. 520. Okay. All right. So now post it. So you will be having here 9,535. Inventories 1,350. Trade receivables 680. 5,590. All this is note number 1111. Okay. All right. Equity is done. Other equity is working note 3. 11,228.25. NCI working note 3. 1,283.75. Trade payables 520. 520. So if you now sit to do the total, one 8,032, and credit side also, I mean liability side also should be the same. Okay, so that takes care of question number 12. And with that, also the second concept, that is goodwill impairment, the second consolidation adjustment. Is it done? Yes. Have you guys understood? Done. 4,500 investment we have eliminated, no, Kaushiki? So it will not come again. It's eliminated in the cost of control account. Okay. Done. Okay, fine. So now we'll just write a quick note on that inventory thing. I'll write it in this section because I don't have a space there. Okay. Okay, so write down. This is relating to inventory. In the standalone financial statements of Orange County, the COGS would be rupees 500. That is without fair valuation, which is correct. I'm not denying it. Okay. Standalone wise, it is correct. However, in the consolidated financial statements, comma, opening inventory and hence COGS would be rupees 600. And hence, if this inventory were to be sold, comma, gross profit calculated by Orange County in its standalone books would be higher by rupees 100 as compared to the consolidated financial statements, as compared to the consolidated financial statements. Hence, an adjustment entry is passed in the consolidated financial statements for adjusting the profit of rupees 100. For adjusting the profit of rupees 100. Further, closing inventory of rupees 550 would have been out of the new purchases made in the current year. Since it is specified that all inventory as at 31st March X2 is sold. Okay, so that takes care of the note which you guys wanted. All clear? Okay, fine. So now we take a 10-minute break. It's 9 and we have completed. Take a 10-minute break. We resume at 9:10. What I want you, okay, fine. We resume at 9:10. Then I will discuss the remaining that needs to be discussed. Okay, fine. Take a 10-minute break. See you guys at 9:10. Okay. Nisarg. Okay. All right. So welcome back, guys. So now we have completed the first two adjustments which are there. And now we move on to the third adjustment, that is unrealized profit on intercompany transactions. Okay. Unrealized profit on intercompany transactions. So there may be a case where we sell goods between the parent as well as the subsidiary. We transfer inventories between the parent and the subsidiary. So these are instances that could happen on account of intercompany transactions. There are instances where you are having transactions between the companies, and these transactions are at a profit. These transactions are at a profit. Now the question arises, if we have what you say, profit, should such profit be eliminated? Should such profit be eliminated? And let us understand why the profit will arise, how it will look like, and what will be the impact and adjusting entry to eliminate that impact. Okay. See, suppose I have a parent entity P selling goods to a subsidiary S. Parent's cost is 100. It is selling the goods to the subsidiary at 120. It is selling the goods to the subsidiary at 120. Selling price 120. So for subsidiary, the cost is 120. For subsidiary, it is 120. Now let us suppose that these items are sold to third parties. Sold to third party. That means selling prices, let us say 150. Now the question is, do I need to do any adjustment from a group perspective? See, I made a profit of 20 here. I made a profit of 30 here. So from a group perspective, the cost to the group is 100. Selling price is 150. Profit is 50. So from a group perspective, I'm pretty much okay with this. I don't have to do any adjustment. Where cost is at 20, cost and selling price, the gap of 20 is shown as earned by the parent. 30 is shown as earned by the subsidiary. So from a group perspective, there is absolutely no adjustment required. It's just that I've split it between two entities. The problem arises if this 120 rupees remains in stock. If this 120 rupees remains in stock, okay, unsold. Now there is a problem that arises. What is the problem? Well, I am not complying with Ind AS 2. Sir, what does Ind AS 2 tell us? You have to state at cost or NRV, whichever is less. Your market price is higher, so obviously we assume that NRV will be higher. So therefore cost is 100. But for the purpose of consolidation, what you are going to show, if you don't do any adjustment, is you will show inventory of subsidiary as 120. When in fact the cost to the group is rupees 100. When in fact cost to the group is 100, तो इसको हम लोग बोलते हैं 20 rupees unrealized profit. We call this as unrealized profit. You will have to eliminate this unrealized profit. You will have to eliminate this unrealized profit. So in this transaction, which is the entity which made the profit? It is the entity P, that is the parent. So parent's P&L se kam hoga. Parent's P&L is ultimately the consolidated P&L. So here the entry that will be passed is consolidated P&L account debit to inventory. That is held with S. This is of P. And how much I will eliminate? 20 and 20. This is what I will be eliminating in my consolidation adjustment. Okay. So if I have to do note number 1, PS adjustment and total, it would appear as subsidiary is having 120 in its inventory. I am adjusting 20 and presenting inventory at 100. The second effect of this 20 goes in working note 1, that is consolidated P&L. There I will be reducing 20. There I will be reducing 20. All right. Now the next impact is reverse. Suppose it is a reverse scenario. Subsidiary has sold goods worth 100 at 120 to the parent, and these are in stock with the parent. So the scenario looks something like this now. It's reverse. 120 and subsidiary has no goods. So now what are you going to do? Now also you have to eliminate the unrealized profit. But in this case, the unrealized profit is earned by the subsidiary. The unrealized profit is earned by the subsidiary. So it will be P&L of S and inventory of P. P&L of the subsidiary debit to inventory of P. To inventory of P. Okay. And ultimately, since profits of subsidiary are going to be shared between the parent and NCI, ultimately we will have to share this between the parent as well as the NCI, between the parent and the NCI. So this will form a part of P&L subsidiary is always analyzed. So this will form a part of working note 4. This will go in working note 4. If it is earned by the holding company or the parent company, it goes in working note 1. If it is earned by the subsidiary, it goes into working note 4, where it will be analyzed between pre and post and further between parent and NCI. And if the date of sale is not given, we will always assume that it is post acquisition when control actually existed. When control actually existed. Is it okay? Yes. Have you understood this part? Yes. So let us quickly go through that notes which are there. Okay. All right. Unrealized profit on intercompany transactions should be eliminated in full from the books of the company effecting the sale. Eliminated in full from the books of the company effecting the sale. This is necessary because consolidated financial statements are the financial statements of the parent and the subsidiary presented as one single entity, and hence profit cannot be recognized on transactions with oneself. This elimination will be done until the goods remain unsold, that is, they lie with either of the group entity. That is, they are not sold to any outsider. So inventory adjustment, downstream transaction, that is from parent to the subsidiary, entry will be P&L of the parent to the inventory. Okay, and this is working note 1 as well as inventory is adjusted in note 1. If it is upstream from subsidiary to the parent, then it will be P&L of the subsidiary which you are adjusting, which is ultimately going to go in working note number 4. Inventory in both the cases go in note number 1. Since this is going in working note 4, it will be split between pre and post, parent and NCI. If nothing is given, then please treat it as post acquisition. Then please treat it as happening post acquisition. Okay. Okay. Can it be only inventory? Answer is not necessary. It could also be upstream or downstream property, plant and equipment which is transferred. So this adjustment is exactly similar to that of inventory, except that it requires adjustment of PPE instead of inventory. Okay. So inventory ke badle mein property, plant and equipment will be adjusted. There will be an impact of additional depreciation or savings in depreciation, which would be reversed in the books of the buyer. You would, same like how we do it for fair value adjustment, we would be doing the same. And the same would be for unrealized losses as well. The same would be for unrealized losses as well. Is it okay? Yes. Could you guys understand? It's quite simple. There is nothing much to explain in this. Yes. So is it fine? Yes, all confirmed. Okay. All right. Okay. All right. Fine. Okay. We have what I'll do, can I take a question? We'll take a couple of questions then, and then we shall discuss the uh, solutions. Okay, 1 second. Okay, just give me a minute. Question 14. Question 14. B Limited and its subsidiaries. Yes. Nope, 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 nope. And this one. Just give me a minute. I'm looking for the questions which we can discuss. No. 6. Oh. 47. Okay. A and B. That is something extra. This is something extra. Okay. We had purchased. This was revalued at 27,000. Okay. Fine. All right. We come to question 47. Okay. We come to question 47. This is not there in any of your study modules. It is an old syllabus question, but we have slightly modified it for Ind AS. Okay. All right. So come to question 47. Following are the balance sheets of A and its subsidiary B Limited as on 31st March. You are given land and building, plant and machinery, furniture, inventories, trade receivables, investment, cash at bank, capital, securities premium, general reserve, profit and loss, trade payables. Prepare the consolidated balance sheet after considering the following information. On the date when A Limited acquired shares in B, the latter, that is B Limited, had a reserve of 2,500 and a credit balance in P&L of 3,500. In determining the value of shares of B Limited, plant and machinery, which then stood in the books at 22,500, was revalued at 27,000, and furniture standing in the books at 3,000 was revalued at 1,800. These new values were not incorporated in the books of B Limited. Abhi karenge. B had purchased goods from A Limited for rupees 9,000 in January 20x7 on 100 days of credit, out of which 7,000 are still in stock. A Limited sells to B Limited at a cost plus 25% margin, at cost plus a 25% margin. Okay. So prepare the consolidated balance sheet. Okay. So first things, balance sheet format is ready. And then we move on to consolidation notes. Then we move on to consolidation notes. Straight away populate the values from the question. No thinking, nothing. Okay. So land and building 17,500. 12,500. Next, plant and machinery, 35,000, 19,500. Next, furniture, 6,000 and 2,500. So this gives you 58,500, and this is 34,500. Next, so I have considered 647, 1, 2, 3, 4, 5, 6. Now I will be taking trade receivables, cash, trade payables. Okay, so that and inventories. Okay, so now inventories 20,000, 13,500. Next, trade receivables 28,500, 13,500. Cash and cash equivalents 500 and 6,500. And last one is trade payables 9,500 and 15,000. 9,500 and 15,000. Okay, so that takes care of all assets, liabilities. Now equity share capital of the parent, let us record 10 each. Okay, so that gives me 11,000 equity shares of rupees 10 each. Fully paid. 1,10,000. So post it in the balance sheet. Equity capital 1,10,000. Okay. Consolidated other equity, you are going to have all these items which are going to come in there. So we will leave that as it is. And here we will write standalone A Limited. Balances जो भी है. So securities premium 13,000, P&L 14,000. So have I considered 13? Yes. Have I considered 14? Yes. Investments I am yet to eliminate. And what I am left with is capital, general reserve, profit and loss account, and investments. Fair enough. So now we proceed to eliminate the investment by opening a cost of control account. Okay. So what is the stake that I am owning? 3,600 shares. What is the shares here? 4,000. So the stake is 90%. So the stake is 90%. Okay. So you can come to cost of control account, 90% stake. How 90%? Well, you can write here A Limited's stake in B Limited. 3,600 by 4,000 into 100, 90%. 90%. So to investment in B Limited. What is the value? 39,000. 39,000. Okay. So all assets, liabilities, equity, reserves of the parent are recorded. Now we proceed to eliminate the same for the subsidiary. So NCI stake is 10%. NCI stake is 10%. Fair value is not given. So proportionate share of net assets. Proportionate share of net assets. This is the method we have to follow, no other options. So by equity share capital of B Limited. So that is how much? 40,000 into 90% into 10%. 36,000. Equity share capital 4,000. 4,000. Okay. Then we move on to analysis of reserves. Okay. So first thing what I'm having is general reserve of 10,000. Balance sheet of B Limited on the date of consolidation. Balance sheet of B Limited on the date of consolidation. Split this between pre, post. Split this between pre-acquisition and post-acquisition. Acha, are we given the date of acquisition in this case? No, we are not given the date of acquisition. But are you given the information of reserves on the date of acquisition? Answer is yes. That information you are definitely given. So that is enough for the purposes of our recording. Okay. So therefore, pre means balance on date of acquisition. Kitna hai? They have given reserve of 2,500. 2,500. So now it is 10,000. So post acquisition increase. Post acquisition increase 7,500. This is a balancing figure. This is a balancing figure. All the adjustments which are there will take it in the P&L. General reserve, so we can balance it out right now. Okay. All right. So now balance on date of acquisition 2,500. I split it between A Limited and NCI. Okay, so A Limited 90%, NCI 10%. 2,250 and 250. So that takes care of balance on the date of acquisition. Post acquisition increase A Limited, NCI, same ratio. So this gives you 6,750 and 750. 6,750 and 750. That takes care of the reserve, general reserve. Okay. Where are you going to give this effect? COC account, working note 2. This will go to NCI account, which is working note 3. This will go to post acquisition. So working note 1. and this will go to working note 3. This will go to working note 3. Is it okay? Yes. So far, are you there with me? It's a little fast because we know where we have to record and all those adjustments we are fairly aware of. Okay. Yes. So give the effects by pre general reserve 6,750. Sorry, pre general reserve is 250 for NCI. Pre general reserve कितना है for the parent 2,250. 2,250 by post general reserve. Not here. Sorry. Both the tables look the same. $750. सब पागल हो गए. 750. Okay. 2,250, and here add share in post acquisition profits. जनरल रिजर्व का तो है हमारे पास. $6,750. $6,750. Is it okay so far? Yes. Are you able to understand? Yes. Okay, fine. See, the problem with consolidation is it's very, very lengthy. It's very lengthy and it consumes a lot of time. Okay, but the other advantage is it is also very scoring. It is also very scoring. तो हम उसको छोड़ भी नहीं सकते. Okay, because question will definitely come from there. Question will definitely come from there. Okay, so what I will be discussing now is, given that time is a shortage as always, what I will discuss now is these adjustments. Where that question went? Yeah, I will be discussing this adjustment. This is a new one. Okay. And then I will give you the final balance sheet total. I want you guys to solve using the understanding of fair value adjustment, which we already had, to determine what will be the fair value adjustments. Okay, so once you finish the fair value adjustments, you can draft the balance sheet and complete the problem. Okay, so I'll be leaving this for homework, but I'll be discussing this right now. Okay, so B Limited had purchased goods from A Limited for rupees 9,000. Okay. So who is selling to whom? Well, A is selling to B. It is A who is selling to B. So this will be a downstream transaction. This will be a downstream transaction. Sale from parent to subsidiary downstream. So who will be making the profit? Sir, it is A Limited who makes the profit. Does it matter whether it is post or pre? No. Will it be shared between parent and NCI? No. Because NCI are holders in the subsidiary, not in the parent. So parent's profits ultimately will be transferred to the consolidated P&L. Okay. So that is how you will be doing it. So we move on to these are certain adjustments. I will just give you the note on downstream transaction and let us see how many of you can do the fair value transactions correctly. Okay. So downstream inventory sold at cost plus 25%. Okay. Cost to A plus markup is equal to selling price of A. So cost to A कितना होगा? दिया नहीं है. 100. Markup is 25. Selling price would be 125. इसमें से out of 9,000, 7,000 is in the closing inventory of B. Closing inventory of B, 7,000. Therefore, unrealized profit is equal to 7,000 into 25 by 125. That is 1,400. Done? Have you understood this calculation? Yes. Have you understood this calculation? 1,400. Did you guys understand? ये foundation level का calculation है. Okay. This is not even intermediate. Foundation में if you guys have come from that MCQ level, then they used to ask you in chapters like consignment, all those chapters ऐसे आते थे questions. Okay. So this is 1,400 is your markup. Who has sold to whom? A has sold to B. So A's P&L will be affected. A's P&L will be affected. So we have to reverse that. So P&L A debit to inventory. 1,400, 1,400. Where will the impacts go? This will go in working note 1, whereas this will go in note number 1. This will go in note number 1. Okay. Additionally, there is one hidden adjustment. Purchased goods on 100 days credit in January. That means the payment will become due only in the month of April. That means as on 31st March, these balances are outstanding. So we will have to eliminate those balances. We cannot have the balances between the companies. Okay. So we'll just write that as a note. As credit period is 100 days, comma, is 100 days from January 20x7, comma, 20x7, comma, the amount would be unpaid as on 31st March 20x7. Would be unpaid as on 31st March 20x7, and hence requires elimination. So entry will be creditors debit to debtors. Creditors में ही रहता है ये balance. So 99,000 will be deducted from both the places. 99,000 will be deducted from both the places. Effect कहाँ जाएगा? Note number 1. Both the effects will go in note number 1. Okay. Fine. All right. Have you written this down? Did you guys understand credit period adjustment? Yes. Eliminating the balances. Did you understand why we had to eliminate? Yes. All right. So now just post these impacts in the main notes. Note number 1. Note number 1. एक तो inventories minus 1,400. दूसरा trade receivables, trade payables, both will be reduced by 99,000 rupees. Both will be reduced by 99,000 rupees. The question is, what do we do with the inventories? We have given one effect here, that is in the inventories account. The other effect will go in note number, working note number 1. Less unrealized profits on downstream transaction. Working note 6. So that one we will deduct it from here, 1,400. Okay. We will be deducting it from here. Done? Yes. All right. So with that, we have completed this adjustment. Now the problem is all yours. Now the problem is all yours. Try to solve it. I think you should be in a position to get. The balance sheet should total to 1,68,000. The balance sheet should total to 1,68,000. Okay. Try to complete this today itself. You should be in a position to get the answers correctly. Will you try this out for me, please? Yes. Okay. All right. Now, yes, that is right, Srishti. I'll not read out your answer, but it is correct. Okay. Go ahead. Go ahead. Absolutely right. Okay. So solve it. You should be in a position to get the answer. Okay. So once that is done, then in the next session on Tuesday, we will look at some problems relating to unrealized profits, not balance sheet, but certain problems. And in fact, why don't I give those problems to you for homework? Let us see. Try to delegate the work. These are small questions. Okay. I want you to go through question number 13 for homework. Okay. Simple question hai wo. Go through question number 13. Go to question number 15 for homework. Question number 16. Question number 17, 18. You do the question, but ignore tax rate. Ignore tax. Homework. Ignore tax. Do this for homework. Question 19, homework. Yes. I want you guys to try these questions. Okay. Small questions hai, kuch khas hai nahi. Okay. So this one, and then try to complete that question number 47, which we were doing. Okay. Once that is done, even if you're stuck, don't worry. I'll be doing it on Tuesday, but I want you guys to try it. Okay. All right. So that's it for today then. See you guys on Tuesday now. Tuesday we have, Thursday we have, and next Saturday we have. So we have lots to cover, and that's this, miles to go before I sleep. Miles to go before I sleep. Okay. So that is how we are there. Let us see how we can do to the best of our abilities. Okay. If you have any issues with the sessions and the speed or the manner, please do let me know. Okay. I'll try to make any changes which will suit you. Okay. Thank you once again, and see you guys on Tuesday. Okay. Thank you. Nisarg.